CEOs are panicking. I'm your host, Steve Van Metre, and thanks for joining me today. A shocking report reveals that CEOs are about to start slashing jobs as the global economy is on the brink of a recession. Let's over to CNBC where we pick today's story up. We must change our course. The UN warns that the world is on the brink of a recession. A global slowdown could potentially inflict worse damage than the financial crisis in 2008, as we've been warning on the show, and the COVID-19 shock in 2020 warned the UN CTAD in its recent Trade and Development Report for 2022. All regions will be affected, but alarm bells are ringing most for developing countries, many of which are edging closer to debt default. And this is a topic, that we've talked about on the show, that these countries are in big danger. There's a global dollar shortage, and when dollars gets pulled out of their countries and exchange rates widen, well, the only course is an eventual default. Today, we need to warn that we may be on the edge of a policy-induced global recession, according to the Secretary General. We may have time to step back from the edge of recession because we're just on the cliff. Nothing is inevitable. We must change course and change immediately. This year's interest rate hikes in the U.S. will cut an estimated $360 billion of future income for developing nations, excluding China, while net capital flows to developing countries have turned negative. On net, developing countries are now financing developed ones, the report said. Now, this is a key point. When we talk about this global dollar shortage, you're hearing it right there in this report. Developing countries who need dollars are seeing outflows, and those outflows, of course, mean there's a global dollar shortage. They're losing money. It's flowing into developed nations. It's not how the system should work. And this is why, as we talked about in yesterday's show and previous shows, that when you have these extreme moves in the currency market, you tend to see things blow up. Interest rates hiked by advanced economies are hitting the most vulnerable the hardest. Some 90 developing countries have seen their currencies weaken against the dollar this year. And debt distress is growing in South Asia and Western Asia. Sri Lanka has fallen into sovereign default. Afghanistan remains in debt distress. And Turkey and Pakistan face rising bond yields along with the rest of the world. It's said that the latest Global Manufacturing Purchasing Managers Index, which we touched on yesterday, which measures industrial activity, indicated global industries have weakened significantly and are set to perform worse in the coming months as high inflation and rising interest rates take their toll. So we're already seeing the UN just echo what we're seeing in the data, that the global economy is slowing. Yet there's one thing that shouldn't get worse if the stock market heads lower in the coming months, and that's your portfolio. I'll put a link up here to Portfolio Shield and description below. Let's continue on because let's look at the chart that validates exactly what we're seeing from the UN. And here we can see the current new orders diffusion index for the Philly Fed in blue. And if we are indeed seeing further deterioration in the manufacturing sector in the months to come, this blue line is going to go even lower. Now, overlaid against that is the Wilshire 5000 in red on a year-over-year rate of change, the total U.S. stock market. And if we see new orders continue to go down, well, there's one direction the stock market's going to head, and that is lower. CEOs are preparing for a recession, and they don't think it will be short. According to a survey of 400 leaders of large U.S. companies by consulting firm KPMG, a whopping 91% are predicting a recession in the next 12 months. What's more, the survey released on Tuesday found that only 34% of these CEOs think the recession will be mild and short. So here we can see that even those who are on the top of these big companies that have all of the data, see it in real time, are saying that this recession, despite what the Fed is claiming, is neither going to be short or mild. Companies are preparing for a downturn and planning to cut expenses. A big way to slash costs? Well, that's job cuts. KPMG noted that more than half of the CEOs are considering workforce reductions to deal with the recession, and that's just today. A survey of mid-market companies conducted last month by accounting advisory firm Markham and Hofstra University School of Business showed that more than 90% of CEOs of mid-sized companies are concerned about a recession. More than a quarter of these CEOs said they've already begun layoffs or plan to do so within the next 12 months. So we know that the worst is to come. Of course, we've looked at charts. We know that when new orders collapse, we know when the manufacturing sector deteriorates, the next thing to go is the job market, and that is coming soon. But what do these CEOs see that perhaps we don't? Well, let's check this out. Back now to the Wall Street Journal. Cargo ship owners cancel sailings as global trade flips from backlogs to empty containers. Dozens of sailings from Asia to U.S. ports are set to be canceled in October as deteriorating economic conditions weigh on demand to ship goods worldwide. Trans-Pacific shipping rates have plummeted, which is not inflationary, roughly 75% from a year ago level. The transportation industry is grappling with weaker demand as big retailers cancel orders with vendors and step up efforts to cut inventories. FedEx recently said it would cancel flights and park cargo planes because of a sharp drop in shipping volumes. And of course, we talked about Nike, who's now sitting on 65% more inventory than they did last year. For 2 weeks starting October 3rd, a total of about 40 scheduled sailings to the U.S. West Coast from Asia and 21 sailings to the East Coast from Asia have been scrapped. According typically this time of the year, an average of 2 to 4 sailings a week are blank, the industry's term for canceled sailings. So we're already now seeing, this is a leading indicator. You talk about, leading and lagging indicators. The shipping data is a leading indicator because if we're seeing a pullback here, if you're seeing orders being canceled, you're seeing shipments being canceled, well, that's going to have a direct economic impact. What this tells us is that inventory levels are too high, that retailers and wholesalers are going to slash prices to clear it, and along with that, jobs. U.S. logistics managers' gauge rises for the first time since March, validating that perhaps these transportation costs that are heading lower are a problem as warehouse costs stay high. And high levels of inventories permeate the global supply chains, and this is bad news. Transportation continues its slump while warehousing is chugging along at the same breakneck pace we have observed for much of this post-pandemic recovery period. Most of this confusion can be attributed to the high levels of inventory that continue to permeate global supply chains. And this is something that our chief strategist, Jeff Snyder, has been talking about. And now you can still get him for a limited time with a big discount on our Markets Insider Pro. And by the way, for those who signed up, our first trade pick 2 days later that we put out to our subscribers is already in his target. For those that took it, they're going to pay for their whole year report in 2 days. Let's continue on. Because warehousing capacity stayed below 50 and utilization jumped, a combination that bodes ill for companies hoping warehousing costs will ease anytime soon from these high levels. Even if some warehousing space comes online, respondents are pessimistic there will be enough to take significant pressure off price growth, meaning the market's bullish on warehouses at a time that the Fed is committed to killing this inflation bug. Well, they're not going to just kill it, they're going to squash it, because when they do, we're going to be sitting on a massive amount of inventory that's got to be cleared, and that, my friends, is deflationary. Fed pivot trade sparks again as bonds rally, dollar weakens. This from today as the market looks toward the JOLTS report. With the so-called Fed pivot has long been hoped for, and the market acting over the last 2 days like it's coming, it got another jolt this week with the release of weaker than expected manufacturing data in the U.S. The dollar extended losses Tuesday, and European equities jumped. As U.S. job openings now dropped to 10.1 million, the lowest since June of 2021. Vacancies declined by 1.1 million, and there's now 1.7 openings per unemployed worker, down from 2. Now, this is not a good sign because normally it'd be interpreted as, hey, there's a lot of people getting jobs. It's just the opposite you're about to see. It's employers cutting jobs. The 1.1 million decline in vacancies was the biggest since April 2020. Think back to the pandemic, and is consistent with moderating labor demand, reflective of the shifting consumption patterns, a declining stock market, rapidly rising interest rates, and darkening economic outlook. And here you can see in this chart that really job openings are a function of the equity markets. Here we see the Wilshire 5000 heading lower. And as we've talked about in previous shows, when we look at the JOLTS data, it was only inevitable that we see that blue line head lower, because all it means is employers are losing confidence, as the CEO survey said. And when they lose confidence, they cut orders, they cut shipments, and then they cut jobs. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.